For this session, we talk about your non-current assets subsequent measurements. So the standards in point for this particular session is still your FAS 16, the standard applicable for property, plant, and equipment. As to its subsequent measurement, we will look into the subsequent measurement under FAS 16 and FAS 36 for your impairment of assets. So before we start, I will just say that in your PAS 36 is the type of standard that is considered a general type of standard which apply to all assets without impairment on their particular standard. Okay, so for example, PAS 2, we're done with PAS 2 inventory. So what is the impairment desk? Impairment desk, we have lower of cost and NRV. Now we are in PAS 16, PPE. So PPE does not have their own impairment test. Okay, so if that particular standard does not have its own impairment test, then we go to their blanket standard, which is PAS 36. So we use PAS 36 impairment of assets. Again, impairment of assets, PAS 36 will only apply if ever that particular standard will not give its own impairment test. So in our example, PAS 2, it has its own impairment test, LC and RV. While PAS 16, it does not have, then we use your PAS 36. Let's start now with your subsequent measurement. So in your subsequent measurement of PPE, we have two models. We have your cost model and revaluation model. So we have almost the same items in our formula to compute for your cost model and revaluation model, except that in your cost, we have first your cost, less accumulated depreciation, less accumulated impairment loss to compute for your subsequent carrying amount. But for your revaluation model, we first get for your fair value. So cost model, whatever is the historical cost, we use that. We deduct the depreciation, we deduct the impairment to get for your subsequent carrying amount or subsequent measurement. However, for the valuation model, we get for your fair value. So we get the fair value based under our IFRS 13 or PFRS 13 fair value measurement. And then we deduct your depreciation and your impairment to subsequently measure it. Okay, so again, we have two models to subsequently measure PPE. Cost and evaluation. Their difference, cost, we measure it first at cost, the historical cost. In your evaluation model, we measure the PPE at fair value to compute for your subsequent carrying amount. So what is the concept of depreciation? Just remember in your subsequent measurement, you need to discuss items of your depreciation and the next item, your impairment. Okay, so let's start first with your depreciation. So what is a depreciation? Depreciation is the systematic allocation of the depreciable amount of an asset over its useful life. Normally, these terms are used in your depreciation. First, it is systematic because it is based on a formula or plan, be it a straight line method, be it based on a sum of the years digit, depending on your depreciation method. Next, it is rational. Why? Because it must represent faithfulness or it fits with the reality. Normally, we look into the life of the asset, and that is your estimated life that must conform with the reality as to the life or the actual life of the asset. Lastly, it is allocation. Why? Because we allocate the cost as part of your carrying amount and your expense. So the expense is known as depreciation. So it's a mode of allocation, not a process of valuation. Why? We only allocate the initial cost to your carrying amount and your expense. Diba? For your cost, as time passed by, we have your depreciation, depreciation, depreciation until it will become zero or based on its salvage value. As you can see, we only allocate the total cost over the life, but we do not actually value it. If we actually value it, we call it already revaluation. But since we are only allocating, we call it depreciation. So When do we apply your depreciation? Your depreciation is applied whether cost model or revaluation model, but revaluation is applied only in your revaluation model. So how do we allocate the cost of your long-lived assets? So for your fixed assets such as your PPE, we call it depreciation expense. For intangibles, we call it amortization expense. Later, we will discuss this one under PAS 38. And for mineral resources, depletion expense under PFRS 6. So the process of allocation of the cost under your PPE is called depreciation, intangibles past 38, amortization, and mineral resources under PFRS 6 is called depletion. So we have two concepts of depreciation. So under financial accounting, depreciation can either be based on your physical depreciation or your functional depreciation. When we say physical depreciation, this is based on the physical attributes of the particular asset. So we look into the assets wear and tear and the deterioration over a period. So based on the physical attribute. So is it already too old? Is it already dilapidated, deteriorated based on its physical characteristics? So what are the main causes of a physical depreciation? Of course, the passage of time, the action of your elements such as your sun, wind, rain, the wear and tear due to use, the accidents, and your diseases. Your diseases is applicable to your animals and wooden buildings. For your wooden buildings, of course, pag inaanay na siya, those are diseases of wooden buildings. For animals, remember uh, their physical depreciation as if ever that is considered an inahin type of animal wherein it is only used for reproduction purposes. So as it goes by, we look into those diseases of animals as a physical depreciation. So depreciation as a concept of physical depreciation based on its wear and tear and deterioration. How about a functional depreciation? For functional depreciation, based on the function of the asset, based on the function of the asset. In physical, based on the physical attributes or characteristics, here based on the function. When we talk about your function, is it still usable? So we look whether it is already obsolete or inadequate to perform efficiently. So is it still usable? Does it still function? So the questions are, is it obsolete or does it perform efficiently? So functional depreciation may arise from first, of course, if your PPE use, there is no more future demand of the product that you use that depreciable asset. So for example, machinery. If you have a machinery to produce a particular product and then suddenly that product is not already considered demandable, then it is already considered depreciated based on your function. Next, when new depreciable asset becomes available, in this case, your asset is already considered obsolete because there is new that can perform more efficiently rather than your old asset. And then lastly, inadequacy, which arises when the asset is no longer useful to the firm because of the increase in the volume of operations. So in your function, we have three items that is considered a reason for your functional depreciation. First, obsolescence, when there is new depreciable asset that is available and can perform more efficiently. Next, inadequacy, whenever the particular asset is no longer useful in the operations of the business because it cannot meet the increase in the volumes. And lastly, it does not perform efficiently or there's no more future demand on your asset. Two concepts, physical and functional. We go now to your depreciation process. In your depreciation process, we need to consider these three items. First, what depreciable base is to be used. This depreciable base is either your cost or your carrying amount or your fair value as depending on the model, whether it is cost model or revaluation model. Generally, under cost model, what we use is your cost or carrying amount. And in your evaluation model, we use your fair value. So normally, you know your depreciable base as your cost less your salvage value. Next, what is the asset useful life? So we need to determine what is the useful life of the asset. Take note that when we talk about your useful life, that is not the physical life. When we say useful life, this is based only on your estimated life of the asset. And lastly, what do we need to consider in our depreciation process? The method of cost apportionment, meaning we call this one as your depreciation method. So we have different depreciation methods based on whether we have your annual depreciation based on a static type or a activity type. So later we will discuss your different depreciation methods. Okay, so in depreciation process, you need to consider these items. First, depreciable base. Next, the useful life of the asset. And lastly, the depreciation method. So first, we determine the useful life. No problem with depreciable base because we're done with your measurement principles. So we go to your second item, your useful life. So how do we determine your useful life? Take note, in your useful life, as I said before, we only estimate it. We do not look the actual physical life. We only estimate it. So normally we retire assets or we depreciate assets on two reasons. What are those again? Physical and your functional. For physical, you already know that one, casualty, expiration, and for your functional, inadequacy, supersession, or obsolescence. When we see supersession, there is a more efficient type of asset. So economic factors, you know this one as your functional. So in estimating, you need to determine these items, your physical factors and your functional factors to estimate the actual life. Take note, we are only estimating, not looking into the actual physical life. So in useful life, always an estimate. Next, the last item into your depreciation process, the depreciation method. So we said first, determine the depreciation base. We already know that one, basing from your measurement principles. Then we determine the useful life based on an estimate looking into their physical and economic or functional factors. And now we determine the best cost apportionment or your depreciation method. So we have your static or uniform. We also have your activity type of depreciation, and we have your accelerated. So the following are the types of depreciation method. First, uniform. In your uniform, when we say uniform, this is based on an equal type of depreciation. So normally, depreciation expense over the years will remain the same. So this is the amount of expense. This is the years. So as years pass by, the depreciation is static or uniform. So equal lang yan. Next, activity. For activity, we have these three items, working hours and two items, working hours and output method. For activity, we place depreciation depending on the level of activity. So for example, the asset performed for 2,000 hours, we place depreciation based on 2,000 hours. We call that working hours. For output, let's say the asset produced uh, 10,000 products, then we should place depreciation based on 10,000 products. So for this working hours and output or activity method, we have this type of depreciation. Sorry. Okay, so type of depreciation here is like this. Why? Because your working hours or your activity or your output differs from time to time. So your depreciation depending on your activity. So your depreciation expense differs depending on your activity over the period. Accelerated. When we say accelerated, we have two, sum of the year stages and declining balance. In accelerated, we have higher depreciation expense during early years and lower depreciation during the latter years. So, sir, why is there a higher depreciation during early years? In your accelerated, it follows the principle that your asset is more usable during its early years rather than in its later years. Therefore, you must provide higher depreciation during its early years. So mas gamit na gamit daw yung asset or mas ginagamit natin siya or mas okay or efficient yung asset during early years kaya mas mataas yung ating depreciation. Kesa sa latter years, kailangan mas mababa na. So how will your graph looks like in accelerated? So we have here your expense, and this is the period. So higher in lower years and lower over the latter years. So higher over the early years. And on your latter year, you can see the depreciation is smaller. Okay? It goes down, accelerated. We accelerate the depreciation during the early years, but we provide for smaller depreciations during the latter years. So depreciation method, uniform, equal, activity, differs depending on your activity, working hours or output, accelerated, pababa yung ating depreciation. We have higher depreciation expense during early years, lower during latter years. Other depreciation methods. The other depreciation methods are not acceptable under PAS 16, but may be used for items with insignificant cost. So normally when we say insignificant cost, these are immaterial items. So first, retirement method. So you will only place depreciation when the asset is retired. Okay, so if you will not make use of that asset already, you provide a depreciation. Replacement, you place a depreciation once you replace a particular asset. You will record the depreciation once you replace a particular asset. For inventory, this talks about your expense or the amount of inventory use. This is the amount of your depreciation. So for example, some of your items of PPE are tools. Okay, so tools are insignificant. So you get your beginning tools, for example, your additional tools, less your ending tools. So whatever is the used tools, that is the amount of your depreciation. That is under your inventory method. So whatever is the expense or the amount used of your inventory, that is the amount of your depreciation. So again, these are not acceptable under PAS 16. However, it may be used for insignificant costs, retirement, replacement, and inventory method. So the other items are acceptable under PAS 16. We have uniform, we have activity, and we have accelerated, but these are not acceptable, only if immaterial. Now, what if there is a change in estimate? So what is a change in estimate? Remember, there are three items that we need to take note in a depreciation process. First, the depreciable base. Normally, that is costless salvage value. Next, the useful life, and then lastly, the depreciation method. So what if there is a change in estimate? So what are these estimates? The estimates can either be useful life, residual value, or depreciation method. Meaning, what if there is a change in your useful life? So previously, it is only 8 years, now it's 10 years. Or previously, it is 8 years, but now 5 years. Or change in residual value. Let's say before your residual value is 0, but now you place 10,000. Change in depreciation method. Let's say you use a straight line, now you use working hours. So if there are changes in estimates in useful life, residual value, or depreciation method, they are accounted for prospectively. So when we say prospectively, current and future periods only. Okay. So for example, year 1, year 2, year 3, year 4. Okay. So the period of change is beginning year 3. So you have depreciation here in year 1 and year 2 based on the old. If there is a change here, either in useful life, in residual value, or in depreciation method, you only apply here in year 3 until the subsequent period. But you will not apply it in year 1 and year 2. You will not apply it in year 1 and year 2 because when we say prospectively, you apply only the change in estimate for the current and future periods. Are we clear? Okay. So again, in depreciation process, we need to take note of three items. First, the depreciable base, the useful life, and depreciation method. All of these are estimates except for your cost. Because your cost is your historical cost, that is an actual salvage value is estimate, useful life is estimate, depreciation method is one of your estimates. So if ever you have a change in useful life, residual value and depreciation method, we account it prospectively, meaning you do not apply it in the previous period. You will only apply it for the current and future period. So this is the previous, year 3 is the current, year 4 is the future period. Not apply in the previous, apply in current, apply in future period. That is your change in estimates. We go now to your impairment of assets. Remember, how do we measure? Cost less depreciation. We're done with depreciation, less your impairment. So we go now in your impairment. Impairment of PPE is covered under FAS 36. So impairment occurs when the carrying amount of the long-lived asset or asset group exceeds its recoverable amount. So carrying amount is greater than recoverable amount, meaning there is an impairment. What is your carrying amount? That is equal to your cost less any accumulated depreciation. So if your carrying amount is greater than recoverable amount, the asset is considered impaired. If the asset is considered impaired, then we will recognize an impairment of asset. But the question is, what is the recoverable amount? The recoverable amount is the higher between your fair value less cost to sell and value in use. We already know fair value less cost to sell. That was discussed under your, what do we call this one? Inventories. Value in use was also discussed in your conceptual framework. Value in use is the present value of future cash flows for the continued usage of the asset. So kaya nga value in use, so based on your continued use, you get the present value of cash flows. Get the higher between them, that's the recoverable amount. And if the carrying amount is greater than recoverable amount, impairment. Take note, there is impairment if CA is greater than RA. Once you consider that the CA is greater than RA, then we have an impairment. So what if there is an impairment? What is the effect on your depreciation? So the effect on your depreciation, whatever now is the residual amount, less your salvage value, this is now your depreciable base. Okay? Your depreciable base now is your recoverable amount. A while back, your depreciable base is cost less salvage value. But since there is an impairment, whatever is the recoverable amount, that will be part of your depreciable base. Are we clear? Depreciation after impairment, instead of getting the cost, we get the recoverable amount. Next, we have your impairment of CGU. So normally your CGUs are impaired. So these are separate units in a particular entity. So we impair this group of units. So how do we impair them? First, you apply to goodwill. First, to apply to goodwill. Then you apply whatever is the excess to the book values of the assets in the CGU, except cash. Okay. So for example, your total impairment, first, you apply it to goodwill. Okay. Whatever is the excess, where do we apply them? To other assets, pro rata, except cash. Okay, remember that? First to goodwill, then to other assets pro rata, except cash. Okay, cash shall not be impaired. And take note, the carrying amount of the asset should not be reduced below the highest of fair value less cost to sell, value in use, and zero. In short, when we apply now the impairment, so let's have the book value of the CGU less the impairment allocated. How do we allocate the impairment again? Oh, we follow this rule. First to goodwill, then to other assets pro rata except cash. Except cash. Okay. So after you allocate it, CGU, the value versus impairment allocation, it should not be reduced by the following. Highest of FVLCTS, value in use, and zero. Normally, this will only come out based on your theories, but soon when you go to intermediate accounting, you will learn how to apply this higher between FVCLTS, value in use, and zero in case of CGU. Okay, impairment of CGU, the total impairment, first to goodwill, then the excess to other assets except cash. Next, impairment of corporate assets. So what is a corporate asset? A corporate asset is a group or divisional asset and does not generate cash inflows independently of other assets. Unlike a TGU, it is a separate unit which generate cash inflows. So the carrying amount of the corporate assets cannot be attributed to a particular CGU under review. So how do we test it? So the recoverable amount is determined for the CGU to which the corporate asset belong, and the carrying amount of the corporate asset is allocated to the CGU which the corporate asset belong. Okay, so let's try to understand this impairment test. So we say a corporate asset is an asset that does not generate cash inflows, and it cannot be attributed to a particular CGU because it is a corporate asset. Any CGU can make use of that. So for example, corporate asset is used by CGU 1, CGU 2, CGU 3. Okay. So let's say the value of the corporate asset is 2 million. Sabi dito, the carrying amount of the corporate asset is allocated to CGU. So you allocate it. So for example, uh, you allocate it pro rata. So for example, CGU1 is valued 2 million, CGU3, CGU2 3 million, CGU3 5 million. Okay. So we allocate it 2 million over 10 million. We have here 400,000, 600,000, and we have here 1 million. So that is the allocation. So after we allocate it, the recoverable amount is determined for the CGU to which the corporate asset belong. So we have already here. So the CGU1 is already 2.4 million, CGU2 is 3.6 million, and CGU3 is 6 million. You compare now the recoverable amount. Okay, so after comparing to the recoverable amount, you determine if there is an impairment. There is an impairment if the carrying amount is greater than recoverable amount. That's what it's meant here in your impairment test. First, you allocate the value of the corporate asset to your CGUs. Thereafter, after allocation, you compare it now to the recoverable amount if there is an impairment per CGU. So CGU1, after allocation, compare to recoverable amount. CGU2, after allocation, compare to recoverable amount. CGU3, after allocation, compared to recoverable amount. That is in case of corporate assets. Okay, corporate assets, take note, it cannot be attributed, therefore we allocate it. Clear? Okay. So a while back in your CGU, how do we apply? First to goodwill, next to other assets except cash. Okay? Now, for corporate assets, first apply to CGU. Compare now to CGU to its recoverable amount and account for any impairment. Now we go with your reversal of impairment. So for reversal of impairment, take note we can impair an individual asset. How do we compare that? Carrying amount versus recoverable amount. We can impair CGU also, as we have discussed a while back, and your goodwill. For individual asset, the difference of the increased recoverable amount is recognized as in the profit or loss. So this is the previous carrying amount. This is now the recoverable amount. This is the new carrying amount. Okay? So carrying amount, recoverable amount, there is an impairment. Now there is a new carrying amount. It means there is a reversal. So what is the rule under your reversal? The revised carrying amount after reversal should not exceed the carrying amount of the individual asset and assets within the CGU if impairment loss was not recognized. So this is only your CGU at that particular amount, 200,000. The carrying amount is 200,000. The new carrying amount now is 300,000. And we previously recognized a recoverable amount only of 120,000. So the difference between the CA or the carrying amount and recoverable amount is considered impairment, 80,000. But we can reverse it now, 120 versus 300. However, guys, you can only revise based on the carrying amount of the individual asset if there's no impairment loss. So you can only reverse up to this extent if there's no impairment loss. So carrying amount, assuming there's no impairment loss, versus recoverable amount is the amount of our reversal. How about CGUs? You allocate the amount of your reversal to your assets on your prorata. Okay? So whatever is the amount of your reversal, only to other assets. Okay? For CGU, reversal only to your other assets, pro rata. But your goodwill, you will not allocate. Okay? Only to your other assets. So reversal, individual asset, you recognize it in profit or loss, not to the extent of your carrying amount, assuming there is no impairment. CGU, whatever is the amount of your reversal, you allocate it to your other assets pro rata. The goodwill will never be reversed. The impairment allocated to goodwill will never be reversed. Take note of the last item. Impairment of goodwill is never reversed. Okay? So we're done now with depreciation. We're also done with your impairment. We go now to your revaluation of assets under your revaluation model. So this is discussed under PAS 16. So after recognition of an asset, the PPE can be carried at revalued amount only if there is a fair value. As I told you a while back, when we discuss your revalued amount, we talk about your fair value based on your PFRS 13. We call this model as your revaluation model. Okay, once you can recognize fair value out of that PPE, then you can use revaluation model. Okay, now, take note for your cost model, what do we look only for your historical cost based on your initial measurement, less your depreciation, which we already discussed, as to its depreciable base, as to its useful life, and as to the depreciation method. And we also discussed already your impairment under PAS 36, wherein we compare your carrying amount to your recoverable amount. We go now to your evaluation model. So the difference here is the fair value. We still have depreciation, we have still impairment. So we have already discussed depreciation and impairment a while back, right? Okay. So the main focus therefore is this item of fair value. So what are the treatments and how do we account for your revaluation? So first, frequency of revaluation. How many times can we revalue? So if there is a significant and volatile changes in fair value, you should revalue annually. You should revalue annually. But if there is an insignificant change, you will only revalue every 3 or 5 years. So based on the volatile changes in fair value, when do you revalue? If it's significant and volatile, annual. If insignificant, every 3 or 5 years. So how do we apply for your revaluation? To compute for your revaluation, we get for your depreciated replacement cost, also known as your fair value, less your carrying amount. Fair value less your carrying amount is your revaluation surplus. So where do we place your revaluation surplus again? OCI, item of shareholders' equity. If you still remember the items of OCI, revaluation surplus is placed in OCI, item of SHE. So fair value depreciated replacement cost less carrying amount is your revaluation surplus. But what if there is no depreciated replacement cost? You just get for the replacement cost, you deduct the observed depreciation. How do we compute for your observed depreciation? The depreciable amount of your replacement cost multiplied by accumulated depreciation over historical depreciable amount. Okay, we will not discuss how to compute, just that please remember to compute for evaluation surplus, fair value less carrying amount, or depreciated replacement cost less carrying amount. Where do we place the evaluation surplus? In the items of OCI, part of shareholders' equity. Now, how do we record your evaluation? We have two methods. There is a proportional method wherein the increase in your carrying amount and accumulated depreciation is recorded. So generally, your entry here is debit PPE. You credit accumulated depreciation and we have revaluation surplus. Okay? under proportional method. However, in your elimination method, the net increase is used to eliminate the accumulated depreciation. So we remove the accumulated depreciation and we record revaluation surplus. If accumulated depreciation is not enough, then we can debit PPE under elimination. We eliminate first accumulated depreciation. If not enough, to the PPE. But in proportional, we increase PPE, we increase accumulated depreciation. In elimination, we decrease accumulated depreciation. Proportional, increase accumulated depreciation. Elimination decreases accumulated depreciation to recognize revaluation surplus. Where do we place revaluation surplus? In your OCI. So how do we account for your revaluation surplus? If that is non-depreciable, the revaluation surplus remains to the OCI. It will be only transferred to the retained earnings when the asset is derecognized. Okay? So for example, land. We have revalued land. If we revalue land, it will remain on your OCI and retain earnings when it is sold. But if that is depreciable, the portion is transferred periodically to the retained earnings. So for example, we have PPE. The revaluation surplus is 2 million. The remaining life is 10 years. So you will transfer periodically over 10 years. So 2 million over 10, so 200,000 to your retained earnings. While here in your non-depreciable, if we have revaluation surplus of 2 million, you will transfer it only once you will sell the non-depreciable. So for example, you sold already the land, so we debit revaluation surplus 2 million, you credit retained earnings 2 million. Okay? So subsequent accounting for revaluation, if depreciable, we will depreciate the revaluation surplus over the life. Non-depreciable, we will transfer it only if it is already sold. And that's the end of our subsequent measurement, revaluation model, and cost model. We talk about your depreciation, your impairment, including revaluation of non-current assets.